Hello and welcome to Accredited Real Estate Schools. This is Bryan Church. This is our third quarter 2022 real estate update. And so let's go through a few questions that I think would probably help us figure out what's going on with the real estate and economics. Matter of fact, through the third quarter of this year. Everyone is, are we in a residential real estate bubble? The reason I use the word residential is because commercial real estate market is just in the toilet, so we don't even want to deal with it. But the residential real estate, that's a good place, in my opinion, to be. Of course, remember, everything we tell you here is to not be used as investment advice because if you want to do that, make sure you see your CPA, attorney, and investment advisor and everyone else. But we're going to give you a good idea what's going on from a macro standpoint in real estate. So anyway, are we in a residential real estate bubble? The answer is probably not this time. Residential real estate bubbles are driven by leverage and hysteria. Too much leverage, however, is usually the main cause of the real estate bubbles. This occurred between 2001 2008 in the United States when lenders made highly leveraged ninja loans. No income, no job, no assets, no problem. Those were those, of course, loans, the stated income loans. What they would do is they would make the loans. The rating agencies, S&P, Moody's, and Fitch would rate them as A paper, even though they were junk bonds, and they would then sell them to investors all over the world who then thought they were getting really good loans, which in fact they were not. We call them the fog up the mirror loans. If you can fog up a mirror, you can get the loan. And that was a big scam. Unfortunately, didn't have very many people go to jail in Wall Street on that one, but probably should have. So anyway, that's one thing is leverage, and also hysteria that kept the residential real estate bubble going longer than leverage by itself. At some point, either interest rate increases or lenders having significant credit losses, residential real estate prices began to decline. That's what we had in 2001 to 2005 and 6 market in California, and then 2008, that's when the stock market had a major adjustment. And short term later, everyone is underwater. Loans are greater than the value of their residential real estate properties, and residential real estate bubble bursts. That's what we had back then. We don't think we're going to have that this time around. And there's actually several reasons why. Today, real estate prices continue to go up. However, this time we do not have the extreme amounts of leverage that caused the 2001 to 2008 residential real estate bubble. This time, lenders have required more substantial down payments. They call that skin in the game, where you actually have to have some money that you put up. Back in that 2001 to 2008 time period, they had the stated income loans, no money down. You just kind of walk in and off you go. You had bus drivers, making $200,000 a year buying $800,000 houses. And to have insured that borrowers really do have a job and have credit scores that indicate they'll have a positive attitude toward repaying debt. So this time around, they actually are doing it the right way. Back then, they did it the wrong way. And at the time, we wondered, either these guys are really, really smart, really, really stupid, but it was neither one. They were actually, the guys making the loans were really, really greedy on that one because they used negative amortization loans, which, of course, gave them compound interest instead of simple interest like most real estate investments. Residential real estate values may decrease in the future, but the decreases are not expected to be as fast or severe as seen during the last downturn that occurred between 2008 and 2011 when the residential real estate market bottomed out, switched from a downward trending buyer's market to an upward trending seller's market. So last time what happened is you had that stock market crash in 2008, which I call it a major adjustment, and then the real estate values dropped precipitously from 2008 to 2011. And that's when the market changed. And it was a downward trending buyer's market. And then, of course, it moved into an upward trending seller's market up until today. So, for example, real estate investors saw the California real estate market start to peak between mid-2005 and 2006. And they unloaded as much residential real estate as possible. These investors held cash after paying their capital gains taxes, and they not doing any 1031 exchanges back into the same inflated residential real estate market. Well, a lot of these guys did is they just cashed out, paid the capital gains, and then sat on the money. And then while waiting for the market to turn into a downward trending buyer's market. So near the bottom of the downward trending buyer's market, which came out to about 2010, 2011, real estate investors, they purchased residential real estate And most of the time it was through short sales and REOs with all cash rock bottom prices. So they bought the short sales. What the short sale is when the property is upside down, they call it underwater, where the loan's greater than the value. We ask the lender to just take the loss now versus taking it after the trustee sale. The REOs, the real estate owned, those are properties that have gone through the trustee sale and no investors bid on it. And of course, the lender end up getting the property back, and then it goes into their REO portfolio, which they then sell to investors. So those are the ones we were buying for pennies on the dollar. Matter of fact, one investor in Sacramento, he purchased a 3-bedroom, 1-bath, 1,000 square foot single family REO, right? He only paid $65,000 cash for it in 2011. Property sold in 2005 for $400,000. Investor rented the property as a permanent long-term rental for about $900 a month in 2011. By 2022, property rents had increased to $2,000 a month and appreciated in value to $400,000. This was the same value the property had attained in 2005, but this time the property's value was based on solid borrower income and low interest rates. In 2005, the property's value was based on stated income loans that were bundled up and sold to investors as A paper when they were actually junk bonds. Loan underwriting guidelines this time around were much more substantial, and real estate investors believe real estate prices will not plummet like they did in the 2008 to 2011 residential real estate market. So what happened was these properties were going for $400,000, but they were artificially inflated because of the financing. And then they dropped down to $65,000. People bought them with all cash, rode the market back up to where it's at now. But now the prices are actually where they should be based on income and interest rates. And back then that was not the case. We knew that too back then, so everybody was unloading everything there right around the time that the stock market crashed or before. And they just sat on the money. Everybody was just sitting on huge amounts of cash waiting for some deals. The deals finally showed up around 2010 and 2011. They bought the properties and off they went. Now, the residential real estate investors, they kept those residential real estate properties as permanent rentals through the pandemic, and then in 2021 or 2022, they started performing 1031 tax-deferred exchanges into newer properties located in higher socioeconomic neighborhoods. Rents in these neighborhoods skyrocketed upward due to the increase in rental demand, pushing rental prices upward. Pricing would be homebuyers out of the market. So people could not buy houses. They end up having to rent properties, and of course, rents went up. Now, the thing of it is that the pandemic of the COVID pandemic had an issue on these permanent rentals because they ran into some issues where the tenants would stop making payments. Then you could not evict them. And then the states got the money from the feds, and they were very slow to disperse the money out to the landlords who were harmed on this one. So it took a long time to do that. So that's what we call a black swan event, and those happen, and those are going to get you, whether you're permanent rentals or if you're vacation rentals, same thing, because in Hawaii, they closed off the entire islands. Florida opened up a lot sooner than everyone else. They didn't get hurt nearly as bad, but in Hawaii, they just wouldn't even let the owners of the properties on the island, much rather, any type of vacation rentals. They did not see a real estate bubble and understand that you only lose money if you sell the property. If you can rent it out for a positive cash flow over the asset's holding period, or you can live there, of course, because you have to have a place to live, you can usually get your money back, sometimes even make a profit in the future. Time usually heals when it comes to residential real estate investments. So as the market goes downward, as a downward trending buyer's market, this time we don't think it's going to go down nearly as fast or as far as it did. And as long as you're still making a positive cash flow, you can just sit on it until it comes back around again, until it becomes an upward trending, seller's market once again. And like I said, time usually heals, so just kind of wait it out. What's driving the higher interest rates that we're having? Well, the answer is inflation. Most important factor when looking at inflation is to compare it to interest rates. Nominal interest rate is the rate a borrower will pay for a residential real estate loan. Real interest rate is calculated by taking the nominal interest rate and subtracting the inflation rate. Let's give you an example on that. For example, if today's interest rate's 5.5%, which is what we're looking at right now on a residential single-family conventional loan, and the inflation rate's 8.5%, which is about where it's at, then the borrower's real interest rate is a negative 3%. You calculate that 5.5% minus 8.5% equals minus 3. This is a negative interest rate. It means that the borrower is being paid 3%, right, to service the loan. In other words, you're making 3% on this. So that's not a bad situation as long as the inflation rate's greater than the interest rate. When you have a loan, you actually benefits you as the borrower. In addition, when the borrower pays the loan back in the future, inflation will make the future dollars the borrower uses to pay off the loan, which will be worth less than the dollars borrowed today. Thus, the debtor, the borrowers, right, benefit from inflation because they pay back the loan with the same amount of dollars that were borrowed, but the dollars are worth less in the future when they're paid back due to inflation. So you make out well there too. So prices go up because of inflation, and you pay back the loan with cheaper dollars. And so there's also some tax advantages as well. If it's your own home, the mortgage interest deduction. If it's your investment property, there's huge amounts of deductions involved there. Real estate's traditionally an inflation hedge because of one, real estate values tend to track inflation. Inflation goes up and real estate prices increase. Real estate loans are paid off with cheaper inflated dollars, benefits the borrower. So there's two things that are good. And then when real interest rates are taken into account, the borrower may be paying a negative interest rate in which the borrower is being paid to borrow money rather than the lender being paid to make the loan. This is why lenders are not happy about making low interest rate loans during inflationary times. They don't like making loans when they're actually going backwards. That's not a good way to do business if you're a lender. The Fed knows this and is increasing interest rates in an attempt to bring nominal interest rates up to the inflation rate and bring the real estate interest rate to a positive number, which the lenders will then make a profit. That's what they're trying to do. Normally it takes about a 2% above the inflation rate to have any impact on reducing inflation. And with today's current data, 8.5% inflation, you add 2% to that, you got a 10.5% interest rate. Now, are we going to ever get to that 10.5%? Well, the Fed is going to try, but it probably isn't going to happen. Fortunately, before the Fed can increase interest rates to 10.5%, the U.S. economy will likely experience a recession, which is in fact where we're heading right now, and a severe stock market adjustment, which is just a nice name of saying a stock market crash that will cause unstable markets. And the Fed, I think a lot of people think the Fed's actually trying to crash the stock markets because it gets rid of the wealth effect. When people think they have a lot of money, they spend more money, and they're trying to reduce inflation, so they don't want them to spend money, so they're going to reduce the wealth effect by popping the stock market bubble. Problem is that when it gets to unstable markets, which will happen very quickly, and then that's a problem for the Fed. So at this point, the Fed will be forced to decrease interest rates in the future, and they'll reduce their quantitative tightening, which is reducing the money supply, which is they're doing right now. And they'll have to move back to quantitative easing, increasing the money supply, and interest rates will end up going back down. And why will they have to do that? Because they're going to be in a really nasty recession. So therefore, real estate prices increase due to inflation. Interest rates are being increased by the Fed to reduce inflation. Interest rate increases cause a recession and unstable stock and money markets. Fed will then be forced to reverse course by decreasing interest rates and printing money through quantitative easing. This will stabilize the stock and money markets, but it'll also cause inflation, which is where we're at now. That is, the Fed has itself neatly boxed itself into a corner and does not have an easy way out. Appears we're going to be stuck with either inflation, stagflation, which, remember, stagflation's inflation with no growth, or maybe even hyperinflation, which is really, really bad, which could be happening in the future. What's causing this inflation? Well, there's an old definition of inflation, which doesn't really work anymore for this. It says too much money chasing too few goods. What we have right here is that fact, but it's not being caused by as much demand as it is supply, and that's where the difference is. So it all started with a decrease in the supply of energy. And one of the main reasons why the reduction of fracking and reduction of oil leases in the U.S., other reasons the Ukraine war resulting in sanctions on Russia, which has driven oil and energy prices up. Higher oil prices have caused supply chain costs to increase. It's called cost push inflation, as caused by increased costs driving oil and food prices higher. So that's a little bit different than the past. The past we had what we call demand pull inflation, where people were trying to buy stuff before it went up in price. Now what we're seeing right now is this cost push, but then we're also now seeing some of the demand pull starting to come in, which is the worst of both worlds. So as prices have increased, consumers start to buy items now before they go up in price. It's called demand pull inflation, caused by people moving purchases forward because they think items will cost more in the future. So now we have both cost push and demand pull, and that leads to a very bad situation for the United States, for California. And back in the 70s, 80s, we experienced the same thing in the 1970s and 80s with the Iranian hostage crisis and the OPEC oil embargo that drove gas prices upward. We're seeing the same thing today. Back in the 70s and 80s, the Fed chairman, Volcker, ended up raising interest rates up to 18%, actually even more than that, to break the persistent inflation plaguing the economy at the time. In fact, the economy was experiencing stagflation because there was no growth and there was high inflation. We're seeing the same thing happening today. It won't be the same thing, but it's going to be very similar, I think. What happened in the 70s and 80s. Actually, I'm old enough to live through that and saw how things happened, and we're seeing a real common denominator with that and today. We've already discussed residential real estate as an inflation hedge, but what about other tangible assets can be used as an inflation hedge? What about gold? Precious metals. Now, gold and also silver can be used, both gold and silver. Some people like to invest in one or both. Silver actually has a really good upside. It's really big and heavy to store and move, whereas gold is smaller, and that's a little bit easier for wealth preservation, whereas silver can be used a little bit more from a bartering situation down the road if you ever get to that point. So gold will initially be used as an investor's flight to safety. This will cause a disconnect between physical gold prices and paper gold prices. I'll explain that in a second. Basel III will cause bullion banks to maintain the amount of physical gold on hand to cover their paper gold trades. No more unlimited supply of paper gold to manipulate the worldwide spot price of gold. Now, here's what was happening. We've had this paper gold market for quite a long time, and these bullion banks, what they do is they trade gold, but they have an unlimited supply because they don't have to actually have it on hand. And so with this unlimited supply, they can manipulate the prices very easily. Well, Basel III says you can't do that anymore. You got to have actual physical gold on hand. You can't just say you have an unlimited supply of that. And so the central banks were manipulating the spot gold price so they could buy gold cheaply on the world markets in anticipation of gold-backed central bank digital currency, which is what, in fact, has happened with Russia, with the ruble being backed by gold. And so that's what we've had this paper gold market that's been artificially pushing prices downward. And once we get to the physical price without the prices downward, which they call the spot price, you're going to see a real increase in the price of gold in the future. At least that's what a lot of the experts are saying. As people lose faith in non-gold-backed fiat currencies, the US dollar will still be the best of all the world's fiat currencies. The US dollar is the dominant world reserve currency because it has a deep bond market through our treasuries. So the fiat currencies, those are currencies that are backed by the full faith of the government, but not anything else. And in the past, before the U.S. went off the gold standard, which Nixon took us off in the early 1970s, U.S. dollar was backed by gold and could be redeemed by gold. They stopped doing that at that point, and now the fiat currencies are coming ahead because politicians always spend more money than they have when they can print up as much money as they want. So countries will be forced to adopt central bank digital currencies that are backed by physical gold reserves, like Russia did. Central banks have been artificially depressing the spot price of gold as they accumulate as much gold as possible in anticipation of a new gold standard that will provide, here's the key word, confidence in their central bank digital currencies. So that's where the gold comes in, is the confidence. And it seems to be working with the ruble in Russia, to give a pretty good example. U.S. is developing a central bank digital currency. Will be backed by gold or merely the full faith of the U.S. government. We don't know on that one. The U.S. has extensive physical gold reserves under the Federal Reserve Bank in New York, and they could be used to back up the U.S. central bank digital currency. And it's priced really, really low too back. I don't remember exact $30 or $40 an ounce, somewhere in that range. And once they market to market at what is it, 1850 or so spot, and even 2000 is a good number. That's of course the amount there is going to skyrocket from what they're actually being held at right now on the books. If this occurs, simple math indicates that a 40% gold backing will increase the price of gold to around about 10 to 15,000 an ounce. 100% is about 40. So there's good upside for the gold in the future. So not only is real estate a really good inflation hedge, but gold looks like to be a really good one as well at this time in the market. That's why we wanted to bring that up, even though it's a real estate update. Just remember there are other avenues out there that can be used to preserve wealth. And then the big question, if we have a global liquidity crisis, could it turn into a global financial crisis like we've had before? And that we don't know. And of course, our fourth quarter update will update you on where we're at that point and see where we're going. It's Bryan Church, Accredited Real Estate Schools. Have a great day.